The Federal Reserve just did something that tells you far more about the system than most people realize. It did not cut interest rates. It did not raise interest rates. It chose to do nothing. But in a highly indebted economy, doing nothing is not neutral. Holding rates steady is a signal that the central bank is trapped between forces that are pulling in opposite directions. One force says inflation is still too dangerous. The other force says the economy is becoming too fragile. One side says raise rates to protect the dollar. The other side says cut rates to protect growth. And in the middle sits a government carrying more debt than at any point when most people learned how this system was supposed to work. That is the real story. Not one meeting, not one headline, not one chairman. The real story is that the Federal Reserve is being forced to confront a problem that traditional monetary policy was never designed to solve cleanly. Too much debt, too much inflation risk, too much political pressure, too much dependence on cheap credit, too much sensitivity in markets, housing, business borrowing, and government finance. And when a system has too much of everything, every decision creates a new problem somewhere else. If the Fed cuts interest rates, it may help the economy, but it may also reignite inflation. If the Fed raises interest rates, it may help defend the purchasing power of the dollar, but it may also break the economy and increase the cost of servicing the national debt. If the Fed does nothing, it buys time. But buying time is not solving the problem. It is postponing the choice. That is why the vote inside the Federal Reserve matters. The decision was not calm and unanimous. It was divisive. Some members believe rates must be higher because inflation and the dollar remain at risk. Others believe rates must be lower because the economy, jobs, and credit conditions are weakening. This kind of split tells you that the institution itself is not seeing a clear path. When a central bank is united, markets receive a message. When it is divided, markets receive uncertainty, and uncertainty is expensive. It affects bond yields, it affects mortgage rates, it affects the stock market, it affects business investment, it affects the dollar, it affects the value of your paycheck, it affects whether people feel confident enough to borrow, hire, invest, or buy a home. Most people experience these things as separate events. A mortgage rate changes, a grocery bill rises, a stock account moves. A company freezes hiring, a car loan becomes more expensive, a paycheck buys less. But underneath all of those experiences is the same machine: money, credit, rates, debt, inflation, and confidence. The Federal Reserve sits at the center of that machine, but it does not control the whole machine. It can influence rates, it can manage the balance sheet, it can signal policy, it can print money or remove liquidity, but it cannot make oil cheaper. It cannot make deficits disappear. It cannot make the government disciplined. It cannot make businesses hire if they are uncertain. It cannot make households feel wealthy if their rent, food, insurance, and transportation costs keep rising. This is why central banking becomes much harder in a late-stage debt cycle. The tools still exist, but the trade-offs become worse. Now the leadership change matters because it changes the reaction function of the Fed. Jerome Powell is stepping down as chairman, but according to the source structure, he is not leaving the Federal Reserve Board immediately. He says he will remain until the investigation by the Department of Justice is truly over, with transparency and finality that matters. Because the Federal Reserve does not make rate decisions by one person's decree. It votes. There are voting members. A majority matters, influence matters, relationships matter, the chairman has power. But the board and committee still matter. President Trump wanted lower interest rates. Kevin Warsh is coming in as the new chairman, and many people expected that this would shift the Fed more quickly toward rate cuts. But if Powell remains on the board, his influence remains inside the institution. That can make the policy shift more complicated than a simple headline suggests. This is an important principle. Systems are rarely changed by one person as cleanly as people imagine. A new leader matters, but the old structure does not disappear immediately. There are existing members, existing data, existing inflation, existing debt, existing market expectations, existing balance sheet constraints, existing credibility concerns. The new chairman can influence the path, but he does not get to start from zero. That is why markets should watch actions more than speeches. A new chairman can say he values independence. He can say he wants to cut rates. He can say he wants to shrink the balance sheet. He can say he wants to redefine inflation. He can say he wants to reduce forward guidance. But the market will eventually judge what actually happens. Words move expectations, actions move liquidity, liquidity moves markets. Now, the biggest problem behind all of this is what I would call the net interest trigger. The United States has more than $39 trillion of national debt. That number is so large that most people stop understanding it. Once a number becomes too big for the mind to feel, the public becomes numb. But you cannot be numb to the interest cost. The United States government is now paying more than $1 trillion a year in interest on that debt. That is not money building roads, funding schools, improving productivity, or preparing the country for the future. It is money paid because past spending had to be financed, and that interest is paid with tax dollars. The source frames it in a very direct way. About 20 cents of every dollar paid in taxes goes to interest payments on the debt. Think about what that means. A meaningful share of the government's revenue is not going toward future capacity. It is going toward the cost of past borrowing. This is how debt begins to change the nature of policy. In the old model, the Federal Reserve had two main objectives: keep inflation under control and support maximum employment. Those are already difficult. But when the national debt becomes very large and interest costs become enormous, a third pressure enters the room: the cost of financing the government. Officially, the Fed may not say its mandate is to manage the Treasury's interest bill. But in reality, the interest cost becomes part of the system's stability. If interest rates stay too high for too long, government interest costs rise. Deficits worsen, more debt must be issued. Bond investors may demand higher yields. The cycle can become self-reinforcing. That is why people are beginning to ask whether the Fed's real focus is shifting from only inflation and jobs to the survival of the debt structure itself. This is not a small shift when a central bank has to think about government interest costs. The line between monetary policy and fiscal policy begins to blur. And once that line blurs, the value of money becomes a much more complicated question. Now, why not simply cut rates? That is the obvious political demand. Lower rates would make borrowing cheaper. Mortgage rates might fall. Car loans might become cheaper. Business loans might become easier. More money could move into the economy. Housing demand could rise. Businesses might invest. Consumers might spend. Stocks might rally. That is the attractive side of rate cuts. But there is a consequence. More spending can mean higher prices. If mortgage rates suddenly fell sharply, many buyers who had been waiting on the sidelines could rush back into the housing market. If supply did not rise enough, home prices could increase. That is inflationary pressure in housing. If businesses and consumers borrow more, demand rises. If demand rises faster than supply, prices rise. That is the basic mechanism. Cutting rates stimulates the economy, but if inflation is already above target, stimulus can make the inflation problem worse. And inflation is not only coming from domestic demand. Oil prices matter. Higher oil prices, especially when driven by conflict in the Middle East, flow through the entire economy. Gasoline becomes more expensive. Diesel becomes more expensive. Shipping becomes more expensive. Fertilizer becomes more expensive. Food transport becomes more expensive. Manufacturing inputs become more expensive. Oil is embedded in the supply chain. When oil rises, inflation pressure can rise even if consumers are not feeling strong. That is the central bank's nightmare: inflation without a strong economy. This is what makes the Fed reluctant to cut. If it cuts into an oil-driven inflation shock, it may undermine its credibility and weaken the dollar's purchasing power. Now, why not simply raise rates? That is what the inflation hawks want. If inflation is the problem, raising rates reduces demand. Higher borrowing costs slow spending, mortgage rates rise, fewer people buy homes, sellers sit longer, some cut prices, businesses borrow less, hiring slows, consumers pull back, the economy cools. That can reduce inflation pressure, but it also hurts the economy. If mortgage rates went to 12%, housing activity could freeze. If business loans became much more expensive, companies could delay expansion or lay off workers. If consumer credit became more expensive, spending could slow. If the economy slows too much, tax revenue falls and deficits worsen. And here is the crucial connection. Higher rates also increase the government's interest burden over time. A government with $39 trillion in debt cannot treat higher rates the same way a low-debt country can. Every increase in rates eventually passes into the cost of refinancing debt. Interest payments rise, the deficit expands. More debt is issued. The system becomes more sensitive. This is why the Fed is trapped. Cut rates and you risk inflation. Raise rates and you risk breaking the economy and worsening the interest burden. Hold rates, and you hope the data resolves the conflict before the system forces your hand. That is not control. That is constraint. Now, Kevin Warsh's proposed approach is interesting because it tries to solve the contradiction. He wants to cut interest rates while shrinking the Fed balance sheet. In simple terms, this means making borrowing cheaper through lower short-term policy rates while removing money from the economy by reducing the assets the Fed holds. The idea is to stimulate the economy with lower rates while offsetting inflationary pressure by shrinking liquidity on paper. That sounds like balance. In reality, it is very hard to execute. To understand why, you need to understand the balance sheet. During crises and periods of stimulus, the Federal Reserve creates money and uses it to buy assets, especially United States Treasuries and mortgage-backed securities. This expands the Fed's balance sheet. It injects liquidity into the financial system and supports demand for government debt. If the Fed later shrinks the balance sheet, it can do so by allowing securities to mature without reinvestment or by selling assets. That removes a buyer from the Treasury market or adds supply to the market. This matters because the United States government is already issuing enormous amounts of debt. If the Fed buys less or sells Treasuries, someone else has to absorb that supply. Private investors, banks, pension funds, foreign governments, insurance companies, money market funds, households. If there is enough private demand, yields may stay controlled. If there is not enough demand, the Treasury must offer higher rates to attract buyers. That is the problem. Warsh can say that private demand will absorb the debt. He can say that shrinking the balance sheet will not raise rates. He can say the market will handle it. But this is an empirical question, not a speech question. Either buyers appear at acceptable yields, or they do not. If they do not, Treasury yields rise. And Treasury yields are the foundation of the whole financial system. Mortgage rates are priced off Treasury yields. Corporate borrowing is influenced by Treasury yields. Bank lending rates are influenced by Treasury yields. Car loans, credit card rates, business loans, municipal borrowing, and asset valuations all live in relation to the Treasury curve. The Treasury market is the global benchmark. So if the Fed shrinks its balance sheet and Treasury yields rise, the entire economy can feel it. This is the risk. You cut short-term rates to stimulate, but balance sheet reduction raises long-term rates. A lower Fed funds rate does not automatically mean lower mortgage rates. If long-term Treasury yields rise, this is where many ordinary people get confused. They think the Fed cuts rates, so mortgage rates must fall. Not always. Mortgage rates are more closely tied to long-term yields and mortgage-backed securities. If investors demand higher long-term yields because they are worried about inflation, debt supply, or reduced Fed buying, mortgage rates can remain elevated even if the Fed cuts. That is why the balance sheet matters so much. It is not just an accounting detail, it is a transmission mechanism. Now, if private buyers do not show up naturally, the government may try to encourage demand. That can happen in different ways. Regulations can make banks or institutions hold more treasuries. Pension funds can be encouraged or required to hold certain assets. Foreign allies can be pressured or incentivized. Domestic savings can be directed toward government debt. This is sometimes part of financial repression. Financial repression is what happens when policy channels savings into government debt at rates that may be lower than true inflation or market risk would otherwise require. It is a quiet way to finance large deficits. It is also a quiet way to transfer wealth from savers to debtors. This is why the shrinking balance sheet story is so important. If the Fed steps back, the debt still has to be financed. If the market does not want enough debt at low rates, something has to adjust. Rates rise, or policy forces demand, or the Fed eventually returns as buyer. Those are the choices. None of them are painless. Now, Warsh has also discussed redefining inflation. That may sound technical, but it is extremely important. Inflation is not a natural number handed down from the sky. It is measured through definitions, weights, substitutions, quality adjustments, housing calculations, and statistical methods. The way inflation is measured today is not the same as the way it was measured decades ago. This matters because inflation affects policy. If the official inflation number is lower than what households actually feel, the Fed may look more successful than ordinary people believe it is. A reported inflation rate of 3% may not match a household experiencing much higher increases in rent, insurance, food, healthcare, property taxes, car repairs, and energy. That gap creates distrust. People say inflation is only 3%, but my life costs far more than that. Both can be true depending on what is being measured if inflation is redefined. Again, the public should pay attention. A new definition may make policy easier to justify. It may make inflation appear more controlled. It may change how the Fed communicates. It may influence expectations. It may also widen the gap between official numbers and lived reality if done poorly. This is not a minor issue. The value of your paycheck depends on real inflation, not just reported inflation. If your wages rise 3% but your cost of living rises 8%, you are poorer in real terms. If your savings earn 4% but your real cost of living rises faster, your purchasing power is falling. People do not live in the CPI index, they live in their own basket of expenses: housing, food, energy, insurance, healthcare, transportation, taxes, education. If those rise faster than wages and savings, the household feels poorer even if the official number says inflation is under control. This is why the Fed's inflation definition matters to your life. Now, Warsh has also discussed reducing regular press conferences and abandoning forward guidance. Forward guidance is the Fed's way of telling markets what it might do in the future. It shapes expectations. It can calm markets or excite them. It gives investors a framework for pricing rates, stocks, bonds, and currencies. If forward guidance is reduced, markets may have less information about the Fed's future path. That can increase volatility. Some people might argue this is good because the Fed should not spoon-feed markets. Others may argue it is dangerous because markets depend on central bank communication. Both arguments have logic, but the practical effect is clear. Less forward guidance means more uncertainty. More uncertainty means investors have to rely more on data, speeches, market signals, and their own interpretation. That can create bigger swings in bonds and stocks around economic releases. If markets do not know how the Fed will react, they may overreact to each data point. This is especially important when the Fed is already divided. A divided Fed plus less guidance can make the policy path harder to read. Now, let us connect all of this to the United States dollar. The dollar is the world's reserve currency. It is used globally for trade, reserves, debt, and settlement. That gives the United States extraordinary power. But that power depends on confidence that the dollar will hold value, confidence that the United States can manage its debt, confidence that the Treasury market remains liquid, confidence that the Fed can control inflation, confidence that policy is not being driven entirely by political pressure. When confidence weakens, the dollar can be pressured. This is why some Fed members may want higher rates to save the dollar. Higher rates can support a currency by making dollar assets more attractive and by signaling inflation discipline. But higher rates also pressure the economy and debt costs. Again, the trade-off appears save the dollar or save the economy. That is too simplistic as a slogan, but it captures the tension in a healthier system. You would not have to choose so sharply. In a high debt, high inflation, risk system, the choice becomes harder. Now, what does this mean for stocks? Stocks like lower rates, because lower rates reduce discount rates, support valuations, and make borrowing cheaper. But stocks do not like inflation that destroys margins, reduces consumer purchasing power, and forces the Fed to tighten. Stocks also do not like a disorderly rise in long-term yields because that makes future earnings worth less and gives investors more attractive alternatives in bonds. If Warsh cuts short-term rates while shrinking the balance sheet, the stock market may initially like the rate cuts. But if long-term yields rise because private demand for Treasuries is insufficient, the stock market may eventually feel pressure. This is why the market's reaction may be complicated. The first headline may be bullish. The second-order effect may not be. Serious investors must think in second order. First order, lower rates stimulate. Second order, balance sheet reduction may raise Treasury yields. Third order, higher long-term yields may hurt mortgages, housing, corporate borrowing, and stock valuations. Fourth order, if the economy weakens, the Fed may have to stop shrinking or restart liquidity support. This is how systems work. A policy is not one effect, it is a chain. Now, what does this mean for your paycheck? This is the part most people feel directly. If inflation rises, the value of your paycheck falls. You may receive the same number of dollars or even more dollars. But if those dollars buy less, you are not better off. The average person is often paid in nominal wages and saves in nominal dollars. Inflation quietly reduces both. After the pandemic, the official inflation numbers showed a large increase in price levels. But many households feel that their real cost of living rose more than the official number. Housing, insurance, groceries, cars, repairs, taxes, and services have moved differently for different people. That is why many people feel poorer even if wages rose. Their paychecks did not keep up with their personal inflation basket. This is the real problem. Central bank policy is not abstract. It changes the value of labor. It changes the value of savings. It changes the cost of borrowing. It changes the price of assets. It changes who wins and who loses. If you own assets that rise with inflation, you may be partially protected. If you only earn wages and hold cash, you may be more exposed. If you have fixed rate debt, inflation can reduce the real burden. If you have variable rate debt, rising rates can hurt you. If you own a business with pricing power, you may adjust. If you are a worker without bargaining power, you may fall behind. This is why understanding monetary policy matters. Not because everyone needs to become a bond trader, because everyone lives with the consequences. Now, what should a regular person do? First, do not build your life around the assumption that the Fed has everything under control. The Fed is divided. Inflation is uncertain, the economy is uncertain, oil is a risk, the debt burden is enormous, the balance sheet is contested, leadership is changing, forward guidance may change, inflation definitions may change. This is not a clean environment. Second, think in real terms. Do not ask only whether your paycheck is higher. Ask whether it buys more. Do not ask only whether your savings account has more dollars. Ask whether those dollars have preserved purchasing power. Do not ask only whether an investment went up. Ask whether it beat inflation and improved your real wealth. Third, reduce fragility. High interest debt is dangerous. Variable rate debt is dangerous. No emergency fund is dangerous. Over-reliance on one income source is dangerous. Holding too much low-yield cash in an inflationary environment is dangerous. Over-concentration in speculative assets is dangerous. Fourth, own productive assets over time. If money is being debased, ownership matters. Stocks, real estate, businesses, and other productive assets can sometimes adjust to inflation better than idle cash. Not perfectly, not without volatility, but over long periods, ownership is usually more resilient than simply holding currency. Fifth, keep liquidity. Do not become so invested that you are forced to sell during stress. Liquidity gives you options. It lets you survive and buy when assets fall. In a confusing policy environment, optionality is valuable. Sixth, diversify. The future path is uncertain. Inflation could persist, growth could slow, rates could move in unexpected ways. The Fed could cut, long yields could rise. Stocks could rally or fall, the dollar could strengthen or weaken. A good portfolio should not depend on one narrow prediction. Seventh, pay attention to Treasury yields. For most people, the Fed funds rate gets all the headlines. But long-term Treasury yields may matter more for mortgages, housing, corporate borrowing, and stock valuations. If the Fed cuts but 10-year yields rise, the real-world easing may be limited. Eighth, pay attention to the Fed balance sheet. Most people ignore it because it sounds technical. But the balance sheet affects liquidity and demand for government debt. Shrinking it while deficits remain large is a major experiment. Now, I want to return to the internal fight at the Fed. This is not just personalities arguing. It is a sign that the system has entered a regime where the trade-offs are worse. In a simple inflation problem, the Fed raises rates. In a simple recession problem, the Fed cuts rates. But when inflation is too high and the economy is fragile at the same time, the choice becomes much harder. This is why some members want to raise and some want to cut. They are both responding to real risks. The inflation hawks are not imagining inflation. The growth doves are not imagining economic weakness. The problem is that the system has both. That is what makes the environment unstable. If the Fed chooses one side, the other risk may grow. If it chooses the middle, both risks may remain unresolved. This is why the market must watch incoming data very carefully. Oil prices, inflation readings, wage growth, jobless claims, consumer spending, credit delinquencies, housing activity, treasury auctions, dollar strength, market liquidity. These signals will tell us which pressure is becoming dominant. Now, the debt interest problem is perhaps the deepest pressure because it does not go away easily. Even if inflation cools, the debt remains. Even if the economy grows, interest payments remain large. Even if rates fall, refinancing schedules and deficits still matter. The government must fund itself every year. It must cover deficits and refinance maturing debt. If buyers demand higher yields, the cost rises. If buyers accept lower yields, the system gets relief. If the Fed absorbs too much debt, inflation and credibility risks rise. This is why the Treasury market is the center of the system. It is not boring. It is the base layer. Every major financial asset is priced in relation to it. The average person sees a mortgage rate. The institutional investor sees the Treasury curve. The two are connected. If the Treasury market becomes stressed, everything becomes stressed. That is why the Fed's balance sheet strategy matters so much. Now let's consider the possible paths. Path 1, Warsh cuts rates, shrinks the balance sheet, and private demand absorbs Treasuries smoothly. Inflation cools, the economy stabilizes, and long-term yields do not rise much. This is the optimistic path. Path 2, Warsh cuts rates. But inflation reaccelerates because oil and demand pressures remain. The dollar weakens, long-term yields rise, and the Fed loses credibility. This is the inflation risk path, path 3. Warsh shrinks the balance sheet, but private demand is not enough. Treasury yields rise, mortgage rates stay elevated, housing weakens, and stocks face pressure. This is the bond market path, path 4. The economy weakens enough that the Fed is forced to cut and stop shrinking the balance sheet, or eventually expand. Again, this is the recession response path, path 5. The Fed remains divided and communicates less, creating volatility because markets cannot understand the reaction function. This is the uncertainty path. A serious investor does not need to know exactly which path wins. A serious investor builds a system that can survive several. That is the point. Now, if inflation is redefined, investors should be careful about trusting only official numbers. This does not mean ignoring data. It means comparing official inflation with your personal cost of living. Track your housing, track your insurance, track your grocery bill, track your healthcare, track your transportation, track your taxes, track your utilities. If your personal inflation is higher than official inflation, you need to plan for that reality. The government's number does not pay your bills. Your actual expenses do. This is especially important for retirees, wage earners, and people holding cash. If your income or savings do not keep up with your actual costs, your financial position deteriorates even if the official data looks manageable. Now, if forward guidance disappears or becomes less reliable, investors should expect more market sensitivity to surprises. Without clear signals, the bond market may become more volatile. Stocks may move more sharply after inflation or jobs reports. The dollar may react more aggressively to policy uncertainty. This does not mean you should trade every report. It means you should not over-leverage. Volatility punishes leverage. If you are forced to sell because markets swing, your system is too fragile. Now, what about the political pressure? President Trump wants lower rates. A president often wants lower rates because lower rates can stimulate the economy, support markets, improve housing affordability, and reduce debt service pressure. But the Fed's job is not supposed to be simply giving the president what he wants. Central bank independence exists because inflation can become politically convenient in the short term and destructive in the long term. If the market believes the Fed is losing independence, inflation expectations may rise. If inflation expectations rise, long-term yields may rise. If long-term yields rise, the benefit of cutting short-term rates may be limited. That is the paradox. Trying to force lower rates can sometimes create higher long-term rates if investors lose confidence. This is why credibility matters. Central banks do not control the long end of the bond market purely by decree. They influence it through credibility, policy, inflation expectations, and balance sheet operations. If credibility weakens, markets demand compensation. That compensation is a higher yield. A higher yield is the market's way of saying, I need more protection. Now, there is another quiet consequence. If the Fed successfully cuts rates while inflation remains high, asset prices may rise. Stocks, real estate, Bitcoin, and other risk assets could benefit from easier liquidity. But ordinary workers may still suffer if inflation erodes wages faster than asset gains reach them. This is one reason monetary policy can increase inequality. Asset owners benefit from liquidity. Wage earners face higher prices. People with fixed-rate debt may benefit. People with cash savings may lose purchasing power. The same policy creates winners and losers. You need to know where you stand. If most of your wealth is in cash and wages, inflation is dangerous. If you own productive assets and fixed-rate debt, inflation may be less damaging or even beneficial in certain ways. This is why portfolio construction is not only about return, it is about your position inside the monetary system. Now let us talk about what not to do. Do not assume a rate cut automatically solves your life. If rates fall but prices rise faster, you may not be better off. If mortgage rates fall but home prices jump, affordability may not improve. If stocks rise but you have no assets, you may feel poorer relative to asset owners. If borrowing becomes cheaper but you take on bad debt, you may become more fragile. Do not assume a rate hike automatically fixes inflation without cost. If rates rise too far, unemployment can rise, businesses can struggle, housing can weaken, and debt service can hurt households and government. Do not assume balance sheet shrinkage is harmless. If the Fed reduces demand for treasuries and private buyers do not absorb enough supply at low yields, borrowing costs can rise across the system. Do not assume official inflation equals your inflation. Track your own life. Do not assume the Fed is one person. Voting members matter. Institutional inertia matters. Old leadership influence may remain. Now, how should you think, like Ray Dalio would think? You build a cause, an effect map. Cause inflation remains above comfort levels. Partly pressured by oil effect, the Fed hesitates to cut. Cause the economy shows signs of weakness and hiring concerns. Effect, some Fed members want cuts. Cause, the dollar and inflation credibility remain at risk. Effect, some Fed members want hikes. Cause, national debt exceeds $39 trillion and interest costs exceed $1 trillion. Effect, the Fed and Treasury face a structural financing problem. Cause, the new chair wants to cut rates and shrink the balance sheet. Effect, short rates may fall, but long rates could rise if Treasury demand is insufficient. Cause, inflation may be redefined and guidance reduced. Effect, public trust and market volatility may change. Cause, real inflation erodes wages and savings. Effect, ordinary households may fall behind even if official policy appears controlled. That is the machine. Once you see the machine, the headlines become less confusing. Now let's think about the average household. A family wants to buy a home. They are watching mortgage rates. They hear the Fed might cut. They think affordability will improve. But if long-term Treasury yields stay high, mortgage rates may not fall much. If lower rates bring more buyers into the market, home prices may rise. If inflation continues, insurance, property taxes, repairs, and living costs may rise too. So the household must do the full math, not just the rate, total monthly cost, income stability, emergency reserves, inflation risk, local housing supply, long-term affordability. A person wants to invest. They hear lower rates may boost stocks. That may be true. But if inflation persists or long-term yields rise, valuations can be pressured. The investor should not chase blindly. They should maintain a long-term allocation, rebalance, and avoid emotional decisions. A worker wants to protect their paycheck. They should focus on increasing skills, negotiating income, owning assets over time, reducing bad debt, and keeping purchasing power in mind. A saver wants safety. They should understand that cash may be liquid but not safe in real terms. If inflation exceeds yield, every person is affected differently. Now, the big picture is that May 15th represents a transition point in the source narrative. A new chairman arrives, Powell remains on the board, the Fed is divided, policy may change, balance sheet strategy may change, inflation measurement may change, communication may change. The public may not notice immediately, but they may feel it later in mortgage rates and stock prices, in the dollar and inflation. In wages, in savings, in loan costs. This is how monetary policy enters everyday life. It does not knock on your door and announce itself. It shows up in prices. Now, I want to close with the most important principle. When a central bank is trapped, do not build a financial life that requires perfect central bank decisions. The Fed may cut too soon, it may cut too late, it may shrink the balance sheet too aggressively, it may fail to control inflation, it may slow the economy too much, it may communicate poorly, it may redefine data in ways that confuse people, it may be politically pressured. You cannot control that. You can control your own balance sheet. That means having liquidity, avoiding high-interest debt, owning productive assets, thinking in real purchasing power, avoiding excessive leverage, diversifying, understanding that the Treasury market affects your mortgage, your portfolio, and your economy, paying attention to inflation as you actually experience it, not relying on politicians or central bankers to protect your savings. That is the practical conclusion. The Federal Reserve did something no one expected, only if you were expecting a clean answer. But in a debt-heavy, inflation-sensitive, politically pressured system, a clean answer is exactly what you should not expect. The Fed held rates because it is trapped. The vote was divisive because the risks are real on both sides. Powell staying on the board matters because institutional influence remains. Warsh's plan matters because cutting rates while shrinking the balance sheet is an experiment with serious consequences. The net interest trigger matters because government debt has become a central constraint. The balance sheet matters because someone must finance the debt. Inflation measurement matters because your paycheck is only as good as what it buys. Forward guidance matters because uncertainty changes markets. And your response matters because the people who understand the machine can position themselves better than those who only react to the headlines. The future path is uncertain, but the principles are not: protect purchasing power, respect debt, own assets thoughtfully, keep liquidity, avoid fragility. Think in systems. That is how you survive and build wealth when the central bank itself is no longer sure which problem it is supposed to solve. First,